Imagine waking up every single month and seeing fresh cash hit your account without working extra hours, without driving for Uber, and without constantly checking the stock market every 5 minutes. That's exactly why millions of Americans are suddenly becoming obsessed with high-dividend ETFs that pay monthly passive income. While most people are stuck relying on a paycheck that disappears after bills, smart investors are quietly building income machines that keep paying them month after month. And in 2026, with inflation still hurting household budgets and retirement fears growing across the United States, monthly dividend ETFs are becoming one of the hottest investing trends in America. But here's the crazy part. Most beginners are buying the wrong dividend funds completely. They chase massive yields, ignore hidden risks, and end up losing money instead of building real wealth. So in today's video, we're breaking down the best high-dividend ETFs paying monthly passive income in the USA, how they actually work, why wealthy investors love them, and which ones could potentially help you create steady monthly cash flow for years to come.
Now, before we jump into specific ETFs, it's important to understand why monthly dividends are such a big deal in the first place. Most traditional dividend stocks in America pay investors every 3 months. That means you wait an entire quarter just to receive a payout. But monthly dividend ETFs change the game completely because they generate income every single month, almost like creating your own paycheck from investments. For retirees, this can help cover monthly expenses like rent, groceries, utilities, and healthcare. For younger investors, it creates a psychological advantage because seeing money arrive monthly keeps people motivated to continue investing consistently. And thanks to the power of compound growth, reinvesting those monthly dividends can dramatically accelerate long-term portfolio growth over time. One of the biggest names dominating the passive income world right now is the JP Morgan Equity Premium Income ETF, also known by its ticker symbol JEPI. This ETF exploded in popularity because it combines two things Americans love: high monthly income and lower volatility compared to many growth stocks. JEPI invests in large American companies, while also using covered call strategies to generate additional income. Now, that may sound complicated, but here's the simple explanation. The fund basically earns extra money by selling options contracts on stocks it already owns, and then passes much of that income back to investors through monthly dividends. That's why many investors suddenly became obsessed with JEPI during periods of market uncertainty and high interest rates. Some people are earning yields far higher than what traditional savings accounts or treasury bonds were paying just a few years ago.
But JEP isn't the only F making headlines across the United States. Another massive player is JEPQ, which follows a similar strategy but focuses more heavily on technology stocks, like companies inside the NASDAQ. This gives investors exposure to powerful tech growth while still generating monthly income. And that combination is extremely attractive in today's market because Americans want both growth and cash flow at the same time. Many younger investors especially love JEPQ because it feels like a blend between aggressive tech investing and passive income generation. Of course, higher yields can also mean higher risk, especially when tech stocks experience volatility. So understanding your own risk tolerance is incredibly important before investing in any high-yield F. Then there's SHECT, the Schwab U.S. Dividend Equity F, which has built an almost cult-like following among long-term dividend investors. Even though SHECT does not pay monthly dividends like JEP or JEPQ, many investors still combine it with monthly Fs because of its strong reputation for quality dividend growth. SHECT focuses on financially strong American companies with long histories of paying and increasing dividends over time. And that's one of the biggest lessons smart investors understand. A giant dividend yield means nothing if the company eventually cuts the payout. Sustainable income matters far more than flashy numbers. That's why experienced investors often balance high-yield Fs with safer dividend growth funds that can survive economic downturns and recessions. Now here's where things get really interesting. A lot of Americans are now trying to build what's called a monthly income portfolio. Instead of relying on one ETF, they combine several different income-producing assets together. For example, some investors mix monthly dividend ETFs, REIT funds, bond ETFs, and blue-chip dividend stocks to create diversified cash flow. This strategy can reduce risk while creating more stable income streams. Imagine owning a portfolio where dividends arrive almost every week from different sources. That's the type of financial setup many Americans are chasing right now, especially people who dream about early retirement or escaping the traditional 9-to-5 lifestyle. But there's also something most finance influencers don't talk about enough, and that's taxes. In the United States, dividend income can be taxed differently depending on whether dividends are qualified or non-qualified. Some monthly income ETFs generate distributions that may not receive favorable tax treatment compared to traditional qualified dividends. That's why many experienced investors hold certain dividend ETFs inside tax-advantaged accounts, like a Roth IRA or 401k whenever possible. This can potentially reduce IRS tax burdens and allow passive income to compound more efficiently over time. And honestly, understanding taxes is one of the biggest differences between average investors and wealthy investors in America. Rich people don't just focus on making money. They focus on keeping more of the money they make. Another major factor driving the popularity of monthly dividend ETFs is the fear surrounding retirement in America. Many younger workers no longer believe Social Security alone will be enough. Pension plans are disappearing. Inflation keeps rising, and everyday expenses feel more expensive than ever before. So naturally, people are searching for ways to create independent income streams outside of traditional employment. And monthly income investing psychologically feels safer because investors can actually see cash flowing into their accounts regularly. It creates a sense of progress and financial control that many Americans feel they've lost in today's uncertain economy.
Now let's talk about one huge mistake beginners make when chasing dividend income. They focus only on yield. If they see an ETF paying 15% or 20%, they immediately think it's amazing, but extremely high yields can sometimes signal danger. In many cases, those payouts are unsustainable, or the underlying asset value slowly declines over time. Smart investors don't just ask how much an ETF pays. They ask where the income is coming from, how sustainable the strategy is, what the long-term performance looks like, and how much risk is involved. Because ultimately, passive income only works if the investment itself remains healthy for years into the future. And here's something even more powerful. Many Americans are now using dividend investing as a way to reduce financial stress instead of becoming ultra-rich overnight. Think about it. If your portfolio generates enough monthly cash flow to cover your car payment, phone bill, groceries, or even rent, you suddenly gain more freedom in your life. You may not feel trapped in a toxic job anymore. You may feel more confident taking business risks or building a side hustle. That's why passive income has become such a massive movement in the United States. It's not only about luxury. For many people, it's about peace of mind. At the end of the day, high-dividend ETFs paying monthly passive income are becoming one of the most talked about investing strategies in America for a reason. They offer the possibility of consistent cash flow, easier budgeting, long-term compounding, and a path toward financial independence. But the smartest investors understand that successful dividend investing is not about chasing hype or gambling on unrealistic yields. It's about building a balanced portfolio, understanding risk, thinking long-term, and allowing time and compounding to do the heavy lifting. Whether you're just starting your investing journey or already building a serious income portfolio, the key is consistency. Because in the world of finance, small monthly income streams can eventually grow into life-changing wealth if you stay patient long enough.